Hey, we're rolling into the middle of the trading day here on Wall Street, and it's time for a quick on-the-hour reset. I'm Grant Mercer, this is Storm Stock Solutions, and let's bring some clarity to the chaos in today's markets. The tone right now is mixed. Macro expectations are fairly steady after the Fed's latest cut, but under the surface we're seeing real stress in the AI trade, and some big shifts in how investors are thinking about tech, healthcare, and even personal finance. What's changed since the last hour is the hit to AI and data center names. According to reporting from MarketWatch, Oracle shares plunged roughly 14% this morning, and that sent a shiver through the broader AI complex, including names like Nvidia. The story here isn't just one stock. It's growing fear that big tech's massive AI spending may not be a straight line higher. Traders are treating this as a reminder that the AI theme, while powerful, is also an area to handle with care when expectations for growth and capex are sky high. At the same time, Disney is making headlines with what MarketWatch calls a dramatic shift in its AI strategy, investing $1 billion into OpenAI and striking a deal that lets fans generate short clips using Disney characters. That's a very different flavor of AI exposure than the data center build-out. It's IP, consumer engagement, and brand monetization. Professionals will be watching whether the market rewards that kind of strategic AI partnership, even as the pure infrastructure trade gets questioned. Stepping back to the macro backdrop, the Fed story hasn't moved much in the last hour, but it still frames the day. As MarketWatch highlights, the central bank has just cut rates and may be done cutting for a while. That keeps the focus on how long this rate plateau might last, and what it means for borrowers in areas like housing and refinancing. For equities, it's a wait-and-see regime. Policy is no longer tightening, but it's not clearly getting looser from here either. In terms of quieter setups, healthcare continues to look like one of the steadier corners of the market. MarketWatch points out that the sector screens relatively cheap compared with the broader U.S. market several years into this bull run. At the same time, there's fresh reporting out of Washington that failed Senate votes on Affordable Care Act fixes could let key Obamacare subsidies expire, potentially pushing healthcare costs higher for many Americans. That policy uncertainty is exactly the kind of thing pros watch when they're thinking about insurers, hospital chains, and managed care names, not as a call to buy or sell, but as a risk-reward backdrop. For more speculative tech, another under the radar story. A MarketWatch piece on quantum computing notes, an analyst calling for a potential $205 billion market within a decade, pointing to companies like IonQ, Rigetti, and Wave, but stressing that revenue will be lumpy and patience is required. That's classic early-stage theme behavior. Big upside narratives, very real volatility. And away from tickers, there's an interesting sentiment read from MarketWatch. Roughly 72% of people in a new survey say they'd be happier if they saved or invested more, with far fewer saying more spending would boost their happiness. That kind of shift in mindset, if it persists, could matter over time for flows into savings, retirement accounts, and the broader investment ecosystem. Into the next hour, I'll be watching whether the AI sell-off stabilizes or deepens, how Disney trades on its bold AI bet, and whether healthcare continues to act as a relative safe harbor as the policy headlines evolve. We'll wrap all of that up for you closer to the closing bell. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.